everyone, Mark here from Vidino & Co. In this video we're going to be reviewing common Australian business structures. We'll be going over the pros and cons of each and also suitable scenarios that we feel are relevant for each structure. This isn't meant to be an in-depth analysis of each structure. It's purely meant to give you a basic overview. And if you want to proceed with any particular structure, you should either speak to your accountant or do your own further research. But with that being said, let's get into it. Okay, so the first structures that we're going to be reviewing will be the sole trader and partnership structures. We've bulked these two together because there's a lot of overlap in the characteristics between the two. The sole trader structure is basically just an individual operating a business under their own name. With a partnership structure, it's, for the purposes of this video, majority of the businesses and the sizes we'll be dealing with will be two or more individuals operating under a partnership agreement. Now that can be either a formal written partnership agreement, which we recommend, or just a verbal agreement. Okay, so let's look at some of the pros and cons of these two structures. Basically with the pros, they're both simple and cheap to establish. So putting aside business planning and tax registrations, basically all you need to begin operating with these structures is an ABN. So once you have that set up, minimal ongoing costs are quite minimal. So it's by far the cheapest. These are the cheapest structures to set up and begin operating. The cons are there is no personal asset protection, which is quite a big one. So basically any debts that are incurred under these businesses you will be personally liable in the event that the business can't repay those debts. So if someone was to take legal action against you, or your business went bad and you couldn't repay your creditors, they would be able to chase you up personally and potentially force you to sell personal assets, including your personal home, to repay those debts. So it is quite a big negative there. There's also negative tax implications for higher income earners. So once you start earning over 110,000 or thereabouts, you'll end up paying more tax than what you probably would if you had set yourself up as a company. It's also difficult to attract third-party investment. So if you're looking for third-party investors, they're going to be less inclined to invest in your business if you're set up as sole trader. Certain customers will be also be unwilling to deal with you if you're operating as a sole trader. This is mainly due to potential employment entitlement liabilities. So you may be deemed an employee in certain cases. So some employers will just avoid the risk altogether by not engaging you as a sole trader. Suitable scenarios for these two structures are going to be small side businesses. So these are just businesses that you have no intention of growing, you just have them on the side to generate a little bit of extra income. Or for sole operators and partners who are looking just to make really a basic wage and aren't really generating above that 110,000 per year in income or profit, and also they need to be operating in a low risk business or industry. A company is a completely separate legal entity. A lot of the time when business owners previously operating as sole traders change over to a company, they have trouble distinguishing between the company and themselves. It's important to remember that the company is completely separate from a legal point of view. It has nothing to do with you as an individual. It can sue, it can be sued, it generates its own profits, it pays tax at the corporate tax rate, and it can retain those profits. Now, the company is owned by shareholders and it is operated by directors. Now, if we look at our flow chart here, we can see profits are coming into the company. Those profits will have tax paid on them at the corporate tax rate, which at the moment for small businesses is 27.5%. And at some point in the future, when the directors deem it necessary, they'll pay those profits, those retained profits, out to the shareholders as a dividend. Okay, so let's look at some of the pros and cons of the company structure. So our first one is the limited liability protection. In layman's terms, this means that provided that you operate legally and with due care, generally your personal assets will be protected in the event that the company can no longer pay its debts. There are also the tax benefits, as we discussed previously, for higher income earners. Once your business starts generating sort of above 110,000, you will be better off from a tax point of view operating under a company. It has the ability to retain profits. So if you're looking to reinvest into your company and build it up, it makes more sense and it makes things a lot easier when you're able to retain those profits. And secondly, you can also retain those profits and pay them out as a dividend potentially when it makes a bit more sense from a tax point of view at some point in the future. Scalability, so you will never outgrow a company. So no matter how big your business gets, the company will always remain relevant to you and it will grow with your business. It's also easier to attract third-party investment, so third-party investors will be more likely to invest if they've got a rigid corporate structure to invest into. So some of the negatives of the company structure are the initial setup costs. So initially you're going to be looking at anywhere between probably $1,000 to $1,500 depending on the accountant who's setting the company up for you to establish the company. You're also going to have ongoing costs payable to ASIC, so for the annual company registration fee. So at the moment that's $267. There are also additional reporting requirements which generally your accountant will handle, but that will also increase the accounting fees over the year. So if you don't get your accountant to handle those extra reporting requirements, you need to make sure that you've got your head around them to make sure that you're compliant with any additional requirements. So a company structure is probably going to be the most relevant structure for, I'd say, almost 95% of businesses. Some of the suitable scenarios are if you're looking for scalability, something that you will continue to grow with your business, profits, if you've outgrown your profits under a sole trader or partnership structure, then a company is going to be more relevant for you. If you're looking to attract third-party investment, again, a company structure is probably the best way to go. Or if you're operating in a high-risk industry or business, depending on what type of business you're operating in, you may consider setting yourself up as a company just to give you that extra bit of protection from a liability point of view. A trust is what we consider a flow-through entity. So unlike a company, it does not retain its profits. Any profits that are generated during the year are distributed to beneficiaries. It is not a separate legal entity. It is operated by a trustee who can be either an individual or a company, and the trustee is also the ultimate owner of any assets within the trust. There are two main types of trusts which are generally used for business. One is a discretionary trust, which is also known as a family trust, and the other is a unit trust. Now, under a discretionary trust, the trustee has full discretion as to how much of the profits are paid out to which beneficiaries at the end of the year. Whereas under a unit trust, the beneficiaries will receive their profits based on the unit holding within the trust. So if we look at our flow chart over here, we can see that the profits are coming into the trust. Now, if this was a discretionary trust, beneficiary A and B would receive their profits based on whatever the trustee determines that to be. So one year, beneficiary A might receive 70% of the profits and beneficiary B 30%. And the following year, the situation might change and that might end up being 50-50, but the trustee has full discretion. Whereas a unit trust, the beneficiaries will have a fixed interest. So for instance, beneficiary A might have 50% and beneficiary B 50%, and that's what they're going to be receiving as their share of the profit every year. So some of the benefits of operating as a trust include the limited liability protection, which we discussed under the company structure. This is available to the trust, provided that the trustee is a company or a corporate trustee. There's also significant tax planning benefits if you set up as a discretionary trust. These structures allow a lot of flexibility when it comes to the end of year distributions. So generally with a discretionary trust, you can distribute to anyone within your family group or any related companies as well. So very flexible from that point of view. They can also be used in a hybrid structure, which we won't be going through in this video, but I'll touch on a little bit later. Some of the negatives: trusts cannot retain profits. This could be an issue if you're looking to continue to build the business up, because you're going to have to distribute those profits out at the end of every financial year. You can loan money around, but it does become quite complicated if that's the way you want to go. There's no corporate tax rate, so that 27.5% tax rate is not available to you unless you distribute to a company. But again, that's sort of making things a little bit more tricky. So if you are on a higher, or your business is on a higher income and you don't have a lot of lower income family members to distribute to, you could end up paying a lot more tax than you would have if you were set up as a company. It's not the ideal structure for scalability. So if you're looking to increase in size, because you can't retain those profits and you have to distribute them out at the end of every year, it does make things difficult when you're looking to reinvest those back into the business. The only way to do it is via loans, which do become quite messy. So it's not really an ideal structure from that point of view. They are costly to establish. It's probably the most expensive one to establish, because you're going to be setting up both a trust and a corporate trustee. And also the maintenance costs are going to be similar to that of a company, because you're going to have all the same ongoing costs basically that you would with a company. And discretionary trusts are not well suited for third-party investment. That's basically because there's no fixed interest for someone to invest in. So someone's not really going to be willing to invest in a trust in a discretionary trust if they don't have a fixed percentage of the business. So again, not a good structure for if you're looking to get third-party investment involved. So because of those negatives, the discretionary trusts and trusts in general aren't particularly great vehicles to operate businesses through. They will limit you in the future if you do want to scale up. The one situation where a trust does make sense to operate a business through is if you are operating a small business and you have multiple family members on lower incomes that you can distribute to. That's basically going to be sort of the one main situation. Almost every other situation, you're probably better off operating through a company. I've also mentioned in here to operate the trust as a shareholder of the main trading company. Now, this is relating to a hybrid structure. So where basically we will have a main trading company, and then you'll have the trust sitting underneath that as the shareholder of that company. So in that situation, you're going to be getting the benefit of both structures. You can retain the profits in the main trading company, build that up, and when the time comes to just pay those dividends out to the shareholder, they'll enter through the trust, and then you can pay those out to your family members at your discretion. So that's more of an advanced type structure. They are costly to set up. You're going to be running multiple structures in a situation like that. So it would only make sense if you're generating quite high profits. But I thought I'd put it in here just to let people know that there is that option. Thanks for watching. We hope you got something out of it. We'll be covering some business planning topics in the future. So if there's anything in particular that you wanted covered, please let us know. We'll see you next time.